Let's talk us through, we got 92%, I think, of the earnings in at this point. As you've looked at what they've talked about, what have they said about CapEx in their earnings goals?
Look, I think it goes back to the tepid revenue growth, right? And while the economy has, been pretty resilient here, the investment going forward, I think companies are getting a little scared, especially on the industrial side. We're pretty worried about the back half of the year in terms of gross margins. And we see, what Walmart said the other day, what happened with the Deere report. We think this is going to be the main thing that people are thinking about going forward.
The Deere report is particularly interesting because what they said, as I recall, is we're worried because we think because of trade in part, we're not going to have the orders. So how much of this is the overhang of the U.S.-China trade dispute?
It's hard to tell exactly how much, but I'm going to go half and half, right? I'm going to go half. We're kind of getting to a point in the economic cycle where normally you would be feeling people kind of getting, okay, are we towards the top? And then you throw in the trade stuff, and that probably pushes it over the edge.
What's interesting is sort of what investors actually are going to reward companies for. The theory is that, it's sharebacks and buybacks and dividends. That's what we want, not the CapEx. But on a yearly basis, companies that spend on CapEx actually outperform. What do you prefer?
Right. Well, what's driven the market since the crisis really has been buybacks, and it has been some of that shareholder-friendly action, but that's still not sustainable growth. So you do need CapEx in order to generate sustainable growth if you're a company. The tricky part about CapEx, if I'm a firm and I'm bringing out guidance for the rest of the year, CapEx isn't a decision that you can change on a dime. You can't decide today that you're going to cut it and then increase it tomorrow. So these are things that companies have to plan for a few quarters in advance. So they really have no choice right now and I would agree that you can argue we're closer to the ninth inning than we are the first. It could be a 15-inning game, but they really have no choice other than to really cut back and be careful on CapEx.
Also, Leigh, there's a little chicken and egg with CapEx because typically when companies are going to invest in CapEx it's because they see the demand there for their product. They see the opportunity. If they're not investing, by definition, the CEO is saying, I'm not sure I can see the market for us.
Yeah, exactly. And I want to bring up another thing here, and it comes out of the Caterpillar report, and I think it's important, where look at the companies that are putting up really good revenue growth and have gotten very high multiples. It really is in enterprise tech. It's the subscription businesses. And you see all these other businesses trying to move into subscription because the quants who are driving this market love the recurring revenue, and they love that really stable year-over-year growth number. So, Caterpillar trying to get into subscriptions on basic, services associated with their business. We see this all across the board. And I think you're going to continue to see, just because of this desire, and it goes to the same thing associated with the buybacks, you're going to see companies that are in kind of the services business and subscriptions, especially in that tech side, are the ones that are really going to benefit.
But not even just that. I mean, just going back to the breaking news of Sprint and T-Mobile, for example, like T-Mobile is going to build out that network, and they're prepared to, see a 7.2% increase in CapEx spending in 2019. So, there is the CapEx. You will be rewarded for it if it's something that people and investors feel that you actually need. So is that idiosyncratic for you, or is that sector?
Some of that's probably more idiosyncratic, and that's stock specific, because as you saw, the companies that are cutting CapEx were mostly large tech companies, which I do think has a lot to do with trade. And aside from Facebook, that was increasing CapEx, but they had some idiosyncratic pressures as well. So I do think from a company specific perspective, you can find opportunities even in the tech space, but overall the sector is under pressure.
It raises the question, though, Leigh mentions enterprise software, basically, enterprise tech. Could that be affected by the trade dispute right now we're having, whether it's Huawei or whether it's the overall Chinese trade dispute?
Sure. I think everything in tech can be affected because what's happening is, as we discussed earlier in the segment, tech is really the target of trade. So you end up guilty by association.
So to wrap it up, because you brought it up and started in the beginning that it's about margins. That's really what it is. So what sectors are mispriced when it comes to margins?
I mean, healthcare seems to be cheap here. I think the dip that we had, was largely because of, some political stuff associated with maybe we get single payer and stuff like that. But that's so far down the road that I think it's now getting rediscounted into the market. I still think, tech margins are going to be pretty good. That's actually where I wouldn't be as concerned unless you're Apple, and that does drive a large percentage of the overall. And then again, the small cap tech, I just don't think is going to be impacted by this unless we have a real issue with Main Street businesses, which are the ones that are integrating all of these products. But again, general economy has been pretty resilient there.